Estee Lauder is a stock that I've done many videos on, and it's down over 54% year to date, around 80% from all-time high, 82% from all-time high. After being an amazing performer for so many years, it was perceived as a high-quality company and all those things. Now the stock is down 82% from all-time high. They recently reported earnings. It went down even more. I've been bearish on the stock for a while, but I have to say I'm starting to change my mind. I'm starting to believe the Estee Lauder is starting to get somewhat interesting at this price. So I'm going to do a very quick review of the earnings and all that stuff and let you know my opinion. If I believe Estee Lauder over here is some kind of a generational buying opportunity, it's something amazing, or maybe it's something that we should ignore. But it's not just about Estee Lauder. A lot of those kind of companies have been crashing a lot. Even stocks like Elf Beauty is down 26%. Another amazing stock down 26%. L'Oreal is down 21%. LVMH and so many different ones. They're down 20, 30, 40% on a year. And there has to be some kind of an opportunity in those stocks. And it's only a matter of finding which one is the best of them. And that's what I'm going to try to discuss in the video. For Estee Lauder, a lot of you are familiar with the company. They have many popular brands like MAC, Makeup, and Tory Burch, and so many of them. They're very popular brands. A lot of you know them, very popular company. But this earning has been an absolute disaster. Sales decreased another 4%. And then net EPS was even a loss of 43 cents. Organic net sales, they decreased 5%. They withdraw the fiscal 2025 outlook due to the timing of stabilization of China. China hurts them a lot, not just them, but L'Oreal also, and the companies that own Gucci, and all those brands and all those companies, they're really suffering mainly because of the Chinese market, and they had to reduce the dividend to a better payout ratio. So they also had a dividend cut, which I like, and I wish they just cut it to zero because no one's investing in Estee Lauder for the dividend. People are investing for a turnaround story, and they should focus more on a turnaround stories than trying to pay a dividend. But they did cut out some of the outlook, and they are expecting for adjusted, this is adjusted, earnings per share to be down 77% and 60 cents, between 20 cents to 35 cents. This is absolutely terrible. And this is the problems that I had with Estee Lauder, which I'm going to talk about a little bit later. But they've been talking about the China. And China, yes, it has been weak. And look at the United States, it has decreased a little bit. Middle East, Europe, and Africa on the second one, it hasn't been too bad. Also like a 2% decrease. But then you had Asia, which is mainly in China, it's down 11%. So it's really, really bad. And once China does recover, Estee Lauder will also be able to recover. But this is not just a problem from China. Companies like Estee Lauder, companies like Nike, all those companies pretty much, whenever we had the 2021 stimulus, we had pumped up demand. A lot of them made the mistake of believing that this pumped up demand is going to be here forever. But it wasn't here forever. It was due to the stimulus. And once the stimulus started dissipating, this is what happened. And they were sitting on a lot of inventories. And inventories started increasing up to $3 billion worth of inventories. Now it came back down. So they did manage the inventories. That's very good. But it's, again, not just a China problem, but it's also a problem from the management believing that whatever we had in 2021 was permanent, and it wasn't permanent. And that's why companies like Nike are still struggling to turn it around until today, and Nike is not even growing. And it's the same thing with Estee Lauder. They did manage inventories. It did increase quarter on quarter, which isn't too good, but it wasn't such a huge increase. It's total, I think it's like 65 or 70 million. So it wasn't nothing too bad. And it's pretty manageable, and it's getting better, but it's also because of the management team. You look at gross margins, I was very surprised. Gross margins held up a little bit better. This is a positive that the company isn't trying to lower prices for them to sell the products. So gross profit margins being up is always good. But in terms of SG&A, they still have a problem over there, and it did decrease a little bit, but nothing too crazy, and it has caused net income to be much, much lower. Now, this is the problem I have with Estee Lauder, is if you look at the PE ratio, the PE ratio is still at 35 times earnings. Can you believe it? The stock is down 82% and is still trading at 34 or 35 times earnings. And the main counter argument I get on Twitter always is, why are you using such depressed earnings? Because earnings now are expected to be $1.92 for next year. So if you're using those earnings, of course, Estee Lauder is going to look expensive. The main reason why I'm talking and I'm using those earnings is because it's been over 3 years, almost 3 years, that the company has promised a turnaround. And every quarter is it's supposed to get better, it doesn't get better. Every time they put up a guidance, they withdraw the guidance because of something about whatever. So they're not being conservative, they're not doing something consistent to turn it around. So why would I value Estee Lauder as the best case scenario? People told me, why don't you use the 2021 EPS? It was 645. 2021 was peak everything. I wouldn't want to value Estee Lauder as the best case scenario. I want to value and look at Estee Lauder as the worst case scenario. And now Estee Lauder is trading at 35 times earnings. But you have to admit that this year, 2025, will likely be their worst year. Now, the problem, we've been saying it for a while. We thought 2024 would be the worst year. Then we thought 2026 would be the worst year. But 2025, I mean, it has to be the worst year. Like, it can't get any worse than that. And if you're buying Estee Lauder, you should be betting on the future and not much about the present. But for the future, even though the analyst estimates, they were wrong and they were completely wrong, they're not expecting a recovery back to 2021 and 2022, but they are expecting a pretty stunning increase in earnings per share after 2025, and it's supposed to reach 593 by 2029. And this is what I'm going to use for my valuation model. And if you're buying Estee Lauder, you have to know that this is not Apple, this is not Google, this is not Microsoft. This is a very speculative investment on a turnaround that might happen or it might not happen. But I believe Estee Lauder right now is finally approaching a point where it's actually worth it to do this turnaround. Before, I told you it wasn't worth the risk reward, but right now it's starting to look much, much better. Now, if you look at the historical PE ratio of Estee Lauder, the mean was 33 times earnings because it's perceived as a high quality company, whatever. So the mean was 33 times earnings. Before 2020, it used to trade around 27 to 25 times. The lowest it has traded at was 21 and a half. Okay, now I'm not betting on Estee Lauder getting back to 25 or 30 or 35 times earnings. If we take this number, of 593, and we assume that Estee Lauder trades at 20 times earnings, which has never happened before. So if it does trade at 20 times earnings, you're getting $118 per share. The current share price is $66. We divide it by $66. We get around 79% or pretty close to 80% upside over the next 5 years based on those estimates. And this is on 20 times earnings. So if it was lower than 593, it was, let's say, 490, and it traded at 25 times or 30 times instead of 20 times, then you're also going to get something like, 80%, 85%. But this is the base case scenario. The base case scenario, I'm seeing around 80% on the upside. So it's starting to look interesting in terms of a speculative bet on a turnaround. But if it does get, let's say, 593 of EPS, and it goes back to the historical average of 30 times earning, then you're getting $177 per share, and you divide that by $66, then your upside is like 170%. Absolutely ridiculous if it just gets back to 30 times earnings. So for me personally, looking at Estee Lauder, I don't think whatever you do, if you do a deep dive, whatever you do in maybe a video or you do whatever in your spreadsheets and DCF, I think no one can really predict the turnaround because you don't know how long the situation is going to last in China and you don't know what the management is going to do next. So no matter what calculations and whatever you do, it's a very speculative stock. But looking at some basic numbers, assuming they hit the analyst estimate of 593 and it trades at 20 times earnings instead of the mean of 35 times earnings, then you're still getting around 80%. So for me personally, as a speculative investment, as a small percentage of a portfolio speculative investment, I think Estee Lauder over here is looking very, very interesting. I would say the stock is a buy, but it's a very cautious buy. It's a speculative buy. It's not a buy that I would put in all my portfolio in it because no one can predict the turnaround. But if you're trying to find a turnaround, I have to say, I like Estee Lauder. I think it has the potential to go up 80 to 100% over the next 5 years, maybe up to 170% if they figure it out and it trades back at 30 times earnings would be around 170%. It's not too bad at all. So I like Estee Lauder. It's looking better. I think it's now worth the risk reward if you want to gamble on it. That's all I could say. But it's nowhere close to a sound investment or whatever. Just being honest. And this is my opinion on Estee Lauder, not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.